Hello guys, in this video we're going to compare Netflix and Disney from the valuation perspective, analyze the quality of the stock, and look at the company key operational metrics. My name is George, I'm an investor and founder of a hedge fund grade analytics platform ValueSense. I built an analytics platform specifically to help me answer the questions like this, quickly analyze stocks, get an edge over the market. And in this video, I'm going to use my platform ValueSense to highlight some of the tools and methodologies that can help investors get better results. So first of all, I built a dashboard comparing Netflix to Disney by some metrics. I looked at Netflix key operational metrics and breakdowns of the revenues and users by different segments. First of all, this is the revenue chart for last 12 months in historical dynamics by geography. We can see that the chart is growing and the vast majority of the revenue comes from US and Canada, which is like understandable. Then another cool chart that gives more data points to think about is the net additions of paid subscribers. So this is really cool because we can see that the net additions, they accelerated and the growth rate accelerated by a lot. It's slowing down a bit, but still it shows really great traction. I mean, 40% year-on-year growth rate for net additions is a lot. Another cool thing is what is the breakdown of the net additions. So from the previous chart, we saw that the vast majority of revenues come from USA and Canada, but net additions come from APAC region and EMEA. So a lot of growth there for Netflix to unlock, and we can see that this growth is accelerating. As for paid subs, these are annual numbers, and yeah, net additions, they resulted in growth acceleration of paid subs. We can see that it's continuously growing, which is cool, and currently it's more than 300 million paid subscribers for Netflix, which makes Netflix one of the biggest platforms for subscription services. As for Disney, their revenue breakdown by segment shows that, well, first of all, the revenue looks flattish. If we compare it, if we look at it from the last 12 months perspective, the vast majority of this revenue comes from entertainment segment, and of course, there are experiences and parks. As for Disney streaming services, which is actually its main value drivers, Disney Plus subscribers also look flattish a bit, and overall the subscription base does not show that much growth. And I would even argue that there's not that many growth by looking at this chart. So overall numbers, they look flat. And Netflix actually accelerated the growth from the key operational metrics perspective. Then we'll look at standardized metrics. So we're analyzing the metrics that are present both for Netflix and Disney. Let's look at revenue growth again, last 12 months. We can see that Netflix actually, like from Q4 2023 onwards, Netflix growth rate accelerated, and it's more than triple. It's almost triple the growth rate of Disney, which is a great sign for Netflix, I'd say. Of course, Netflix suffered a huge drawdown during COVID, but then it survived and showed steady growth rates. As for free cash flow margins, Netflix recently turned profitable. Well, it became profitable for quite some time, but it continues to grow its margins, which is a great sign for investors. And the main focus is how much free cash flow margin Netflix is able to generate from the revenues. and we'll see. But currently, the company declared that its focus is on profitability, and it seems that Netflix won the streaming wars and it's spending less on capex, which results in more free cash flow margin. And compared to Disney, well, most recent numbers show that Netflix outperforms Disney from the free cash flow margin perspective, but historically, Disney actually displayed margins uh, similar to current Netflix numbers, but those margins declined severely. As for capital allocation, and if we look at return on invested capital metric, ROIC, we can see that Netflix is just a great capital allocation machine. I mean, their recent dynamics show that they can continue to expand their return on invested capital, and overall, the management displays really great capital allocation skills. I mean, both companies started to increase their ROIC, but Netflix is off the charts, especially compared to Disney. Uh, so by just analyzing like the growth, profitability, and capital allocation, key metrics from growth, profitability, and capital allocation, we can see that Netflix really outperforms Disney, and it all comes down to valuation. I mean, what we pay for companies like this, and what investors paid historically for them. So we can analyze the price to earnings ratio for last 12 months and analyze the historical dynamic. We can see that Netflix was really expensive stock. I mean, the median PE multiple for Netflix was 82 for almost 10 years. But recently it's 50x, which is not cheap again. But in 2022, when the stock was almost beaten to death, the sentiment was very low, was negative, and we can see that for the first time there were actually negative net additions for US and Canada. It was like the first time in company's history, and the market reacted really bizarre, and the market actually stopped believing in the stock, which proved to be a great opportunity for investors in 2022. It was the time when Bill Ackman bought into the stock, then sold. But since then, the company saw only a way up. The Disney valuation actually dropped significantly as well, and there were times where Disney and Netflix traded almost at the same multiples. I should say even the same multiples. And currently Disney trades at 18 PE, and its valuation continues to drop over the period. And also looking at free cash flow yield ratio, which is free cash flow divided by market cap, we can see that of course there was a period where Netflix was not profitable and its free cash flow yield was negative, but since then the company trades at 1.6% free cash flow yield, which is not that much, which means its price to free cash flow multiple is really high, and Disney trades at 5.5, which is good, but it traded at 7.2%. So overall, we looked at the chart comparing two companies. And next, let's analyze the quality of each of the stock and see whether the companies are undervalued or overvalued. So first of all, let's look at Disney. In ValueSense, we have a quick snapshot of company quality by looking at growth, profitability, health, capital allocation, and momentum metrics. For each domain of the quality rating, we compare a company's current number to its historical numbers, comparison to peers and industry. We can say that Disney is is a quality stock. I mean, 6.9 is close to 7, which is considered great. And in some domains of the score, it displays really great ratings. I mean, growth, profitability, momentum. It's decent from the capital allocation perspective and financial health. and overall the quality of the stock, it was really high in 2018, but since then it dropped, especially during COVID here. But then the quality increased, and because company showed its resilience. For if we look at Netflix and compare the same domains of the score to Disney, Netflix shows way greater results and shows greater quality. It's growing faster, it's more profitable, it shows greater capital allocation and great financial health. I mean, it's a dream for investors, and ultimately investors rewarded the stock by paying more attention and ultimately drove the stock only higher. So currently it sits at 1200 plus, which is all-time high, almost all-time high. And I believe Netflix will see another all-time high in the nearest future. But the quality is one thing. Another question is how much we pay for this quality. And for this question, we're going to analyze, we're going to use a reverse DCF calculator from the intrinsic value hub that we built in ValueSense. There are 10 plus tools that investors can use and analyze the intrinsic value of the companies. We can go to intrinsic value page and see that first of all, there are two methodologies how we can apply reverse DCF, either by looking at free cash flow, implied free cash flow growth, or implied revenue growth. I should remind you that reverse DCF is a great methodology because it helps investors not to come up with its own assumptions, but just look at what is the implied growth rate for current price. So let's say we saw that Netflix trades at 1200. We're going to analyze what are the implied assumptions for this price to be fair. Let's assume that 1200 price for Netflix is a fair price. What assumptions does the market imply to make this price fair? So if we are looking at implied free cash flow growth, we plug last 12 months free cash flow growth, free cash flow for NVIDIA, which is 8.6 billion. Its long-term growth rate 4%, discount rate of 10.3%, and its current price. So let's actually insert the most current price of 1226. And boom, we have the implied free cash flow growth rate for the next 10 years. So for the next 10 years, the market assumes that Netflix is going to grow its free cash flow by 20%. We can compare it with its historical growth because it was astronomical because like the company just turned profitable, and since then the growth accelerated. But it's also interesting to look at LTM free cash flow historical dynamics. So by analyzing 3-year compound annual growth rate, we divide this big number by this small number, and like this growth rate, historical growth rate was very high. But we can see that free cash flow is growing and accelerating. Free cash flow margin historically high was 20.5%. Currently it's almost the same and seems to grow. We can also speculate and see and use implied revenue growth by applying like normalized margins. So let's say if we apply current margins to Netflix revenues, we get implied growth rate for revenue by 20%. And compared to historical 10%, that's too much. So probably the market assumes that Netflix is going to increase its margins by quite a bit in order for current price to be fair. So let's say we plug 25%. So the implied revenue growth is now 18%, which is lower. And let's analyze what is the point where market believes is reasonable and until which moment the company is going to grow its margins. So it's probably in 30s, 40%. So market assumes that there's a lot of like margin improvement, margin expansion coming up for Netflix, and We can decide for ourselves whether we believe in these assumptions. I personally believe that market assumptions for free cash flow growth by 20% and 20% for revenue, assuming 25% normalized for cash flow margin, they're a bit high, to be honest. There's not enough room, there's not enough margin of error for me. But I love the stock at its low. I bought into the stock in 2022 because I ran an analysis like this. I understood that the implied growth rates were very low, and it was such a great opportunity. And compared to Disney and doing an analysis like this, we can see that implied free cash flow growth for Disney is only 5%, and historically, free cash flow for last 12 months, Disney continued to grow its free cash flow, which is a great thing. And 5% for 10 years straight is not that much. And we can argue that we can argue that Disney current stock price is fair, and it can be a great value play. If we look at the if we look at the price chart for Disney, we can see that the stock almost didn't move for the 10 years. There was like 28% increase, which is not that much, and the company decreased by a lot since its peak in 2021 bull run, but but by all metrics, it shows that Disney is still a quality stock. The market implies a very pessimistic growth assumption. It can be value play. As for Netflix, Netflix is a way higher quality stock, but it continues to trade at a premium for its quality. And as investors, we can pay up for the quality and say, and we saw that its return on invested capital continues to expand. And as Charlie Munger says, that in the long run, the stock follows its return on invested capital in fundamentals. And Netflix sooner or later will fit into the current price, and we'll still get the results. So all in all, that was the analysis of Disney versus Netflix. We looked at the very complicated dashboard. And if you like the dashboard, you can go to ValueSense, you can check it, you can download all the data, you can download all financials for Netflix and Disney, including KPI and segments data, income statements, ratios, valuation multiples, etc. And you can use stock analysis page for ValueSense to understand the quality of the company and get the 360 view of the stock from different perspectives. Plus use the reverse DCF to analyze the implied growth assumptions. So that's it for this video. Looking forward to your feedback, and see you in other videos. Bye.